Thimar Holding, a produce markets holding from Riyadh, listed as 4160 and the tightest clock in this series. In 2025, revenue was 700,000 riyals against 18 million of operating costs. The net loss was 13 million, the fifth in a row, and cash covers less than 9 months at that burn. The market pays 230 million for 11 million of book. This analysis prices the operations honestly and sequences what a real restart requires. This is the complete CFO in business report. 3 signals stand out. First, the revenue has stopped. 700,000 riyals against 18 million of costs. Second, the company is funded by shrinking. Assets fell by a third in 1 year to cover the burn. The hole is the deepest in the cohort. Accumulated losses stand at 145% of capital. The plan runs 6 actions on 1 road. Reset the capital. Secure funding before any restart spend. Reopen the market floors under contract. Attach distribution to the flows. Sell assets only at fair value. And publish restart KP is every quarter. Sequence from 2026 to 2030. Each action has a gate before the next. The SWOT is honest, because it must be. The strengths: market licenses, land, and know-how that once ran real floors. The weak points: almost no revenue, and less than 9 months of cash. The opportunities: Riyadh produced demand, operator contracts, and a clean reset. The threats: the funding gate itself, and fire sale prices if it stays shut. Michael Porter's 5 forces, drawn on produce markets. Wholesale produce is a thin margin, high-flow trade. Buyers are strong, because retailers can go direct. Growers need market access, which is the leverage. Licenses and land gate new entrants. And the structural threat is farm-to-retail bypass. A market must earn its traffic every morning. The restart model operates markets, not balance sheets. Source from growers and importers. Run the central wholesale floors. Move the goods through distribution. And collect fees, rents, and service income. Market operations are the restart. Distribution is the attach. The land is the fuel, leased or sold at fair value. 4 pillars carry the restart. The people pillar, a skeleton team, honestly sized, growing only with contracts. The technology pillar, gate, way, and fee systems, bought, not built. The infrastructure pillar, floors ready per contract, and no project without funding. And the digital core, a weekly runway watch and quarterly restart KPIs. Every risk carries a probability, an impact, and a named owner. The runway leads the register, owned by the board and treasury. If funding fails, the honest path is an orderly wind down. The register says so. Restart economics are owned by market operations. Contracts first, fees in advance. That is deliberate. Governance keeps the plan honest. The board sets risk appetite and watches the register. The audit and risk committee owns controls and capex stage gates. Management delivers a monthly KPI pack, a quarterly board review, and an annual plan refresh. The context is a capital city that eats more every year. Riyadh adds hundreds of thousands of residents, and food security policy treats wholesale infrastructure as strategic. The demand is not the question. The engine is. Licenses hold value only if someone operates them, and operating them requires the funding gate to open. The portfolio drawn honestly: licenses and land awaiting an engine. Fruits and vegetables, meat and livestock floors. The central markets, the license core, distribution, agricultural projects, and maintenance. Land development positions, produce marketing for growers, and a holding shell around it all. Assets waiting for an operator. Peer comparison at live market caps. Now the cohort contrast. Saudi Fisheries, the other hard case, has a 335 million riyal rights issue approved and pending. Thimar has under 9 months of runway and no announced funding. Same disease. The treatment is now the entire story. Valuation, with every assumption on screen. Risk-free, 4.45. Saudi equity premium, 5.01. Adjusted beta, 1. The WACC lands at 9.3%. The plan discounts to 250.3 riyals per share. The market says 35.36. On a reset and funded base, the plan does not exist without new capital first. Read the grid, not one number. No buy, sell, or hold verdict, ever. 5 catalysts to watch. The capital reset and funding committed in 2026. The market floors reopened in 2027. Services attached in 2028. EBITDA break-even in 2029. And by 2030 is small real business. Every date depends on the first one. 1 grid. 10 years. Actuals in green, plan in blue. Revenue climbs from 0 million to a planned 42 million reals. Earnings per share builds toward 0.08. No dividend is modeled. Survival is the only policy. Labeled illustrative on every panel. 5 years in one chart, and the chart is nearly empty. A write-off era. 2 years of zero, a brief restart attempt, and a stall. Net margin is not meaningful at near zero revenue, so the line is omitted. Honestly, the share churns at 21 times book. The chart is the antidote to the churn. 2 pictures explain the year. The bridge shows costs of a holding and revenues of a kiosk. 16 million of operating costs against almost nothing coming in. The cash picture shows the consequence. A 23 million outflow funded by selling the estate. At that rate, the cash lasts under 9 months. That is the whole analysis. The transformation map is the narrowest road in this series. 2026, reset and funding. 2027, the floors reopen. 2028, services attach. 2029, break even. 2030 is small real business. If the first date stays shut, the road honestly ends there. 9 numbers hold the budget up. Growth of 23.5 to 747% a year. Gross margin walking from 30 to 35%. Capital spending at 10% of revenue, easing to 6. Zakat and tax near 2%, and a payout near 0%. The balanced scorecard makes it accountable. Funding committed in 2026. Owned by the board. A 12-month runway held at all times. Watched weekly by Treasury. 2 market floors contracted by 2027. Owned by commercial. Every target has a cadence and a name. The 5-year plan, in numbers, revenue builds from 6 million to 42 million reals. EBITDA recovers to 9%. Earnings per share reaches 0.08. No dividend is modeled. All of it labeled illustrative, not guidance. The master budget allocates 2029, month by month. This budget is for 2029, the first break-even year, and it depends on the funding gate opening in 2026. Ramadan rules the previous year. January and February carry the floors. Summer fruit lifts the middle. Fees and rents hold the base. 12 months, weighted the way the market floor is set. 3 final charts close the budget. The Ramadan quarter carries the phasing of every 100 halal as a budget. Cost of goods takes 66, and EBITDA keeps 4. Firm cash compounds to 608 million reals across the plan. The complete Thimar holding report is live at cfoinb.com. That is, cfoinb.